Hello everyone, this is Jennifer. In this video we're going to look into the solvency ratio. The solvency ratio is basically done in order to compute and understand the ability of a firm to pay off its long-term liabilities. So basically there are four ratios under solvency ratio. The first one is debt equity ratio. Second is total assets to debt ratio. The third one is proprietary ratio, and the fourth one is interest coverage ratio. So the first one, debt equity ratio, it basically shows the relationship between the long term debts and the shareholders fund. So the formula is debt divided by equity. So under debt, what all it comes? So long term debts or the loans. So long term debts include debentures plus long term loans divided by equity. What all does equity include? Or equity include the shareholders fund. Under that we have equity and preference share capital, reserves and surplus minus any fictitious assets. So fictitious assets are nothing but your intangible assets which are basically accounted in your financial statement. Example could be your advertisement expenses, discount on issue of shares and debentures, etc., which cannot be seen, felt, touched, but it are accountable in your financial statement. So at this time you should understand that goodwill, patent, trademarks are not part of fictitious assets, but they are just intangible assets. So next formula is proprietary ratio. So this ratio indicates the relationship between equity, shareholders fund and the total assets. So in this we show the relationship between the shareholders fund and the total assets that are maintained in the organization. So let us look into our question. The following figures are taken from the balance sheet. So they have given equity share capital, preference share capital, general reserve, 6% mortgage loan, sundry creditors, preliminary expenses and prepaid expenses. They are telling us to calculate the debt equity ratio. So what is the formula for the debt equity ratio? The formula for debt equity ratio is long term debts divided by the shareholders funds. So here what all long term debts we have? Here we have 6% mortgage debentures, that is your long term debts. And what is your shareholders fund? Equity share capital, preference share capital, general reserve for contingency. All this will come under your shareholders fund. And we have something called as a preliminary expenses incurred the initial period, which is 5,000. So you'll minus this in order to find out your shareholders fund. The sundry creditors and prepaid expenses are your current liabilities. So let us find out our shareholders fund. Equity share capital, 6% preference share capital, general reserve for contingency. Total you get up to 2,10,000 minus your preliminary expenses, which is 5,000. You get your shareholders fund to be 2,05,000. So your long term debts we have 6% mortgage debentures, which is 50,000. So your debt equity ratio is long term debts divided by shareholders fund, which is 50,000 divided by 2,05,000, which is 0.24. So moving on to our next question. So your next question, from the following information calculate debt equity ratio, proprietary ratio and ratio of total assets to debt. Okay, they have given the balance sheet and they are telling us to find out all the ratio. So in the balance sheet you will divide, you will categorize into which formula does each item goes. So your preference share capital, equity share capital, reserve, preliminary surplus, everything will come under your shareholders fund. So your long term liability will be considered as your debt, long term debts. So you have your current assets, current liability, which will not be considered anywhere. Then you have your non-current assets, fixed assets and non-current investments. So that and your current assets. So this will be considered in your third formula, which is total assets to debts. So total asset amount is 7 lakhs. So let us see the formula. The first one is debt equity ratio, long term debts divided by shareholders fund. Long term debts they have given us 1,50,000. In your shareholders funds you have 4 lakhs plus 1 lakh, which is 5 lakh. So your debt equity ratio is 1,50,000 divided by 5 lakh, which is equal to 0.30 is to 1. Next you have your proprietary ratio, which is shareholders fund divided by total asset. Your shareholders funds we have already found out, which is 5 lakhs divided by total assets. The total assets amount is 7 lakhs, which is your fixed assets, non-current investment and your current asset. So your formula is 5 lakhs shareholders fund divided by total asset, which is equal to 5 lakh divided by 7 lakhs, which is 0.71 is to 1. So your total assets to debts, which is total assets divided by debts. This is the formula, everyone should understand it. Total assets to debt is total asset divided by debts. So 7 lakh divided by 1,50,000, which is equal to 4.67 is to 1. So let us look into our next set of ratios, which is activity ratio. So activity ratio basically tells how the firm has employed its resources, which is your what kind of resources are we talking about? Stock, debtors, fixed assets, etc. So you basically, these ratios are also called as turnover ratio. So in the question, if they tell you all to find out the turnover ratio, you should understand that it is activity ratios. So the important activity ratios are inventory turnover ratio, debts turnover ratio and creditors turnover ratio. Very important formulas one needs to understand. So your inventory turnover ratio, the inventory turnover ratio shows the relationship between cost of goods sold during a period and average stock carried during a period. So cost of goods sold during a period and what is the average stock that the company has, what is the turnover between the average stock and the sales happening. Okay, so the formula is cost of goods sold divided by average stock. So how do you calculate your cost of goods sold? Cost of goods sold is equal to opening stock plus purchases plus direct expenses minus your closing stock, and your average inventory is found out by opening stock plus closing stock divided by 2. Okay, anything average if they tell, divided by 2. Next ratio is your debtors turnover ratio. So your debtors turnover ratio formula, you're going to show the turnover of debtors and bills payable with reference to net credit sales that are happening. So debtors are directly related to your sales, so you'll show the relationship between both of them. So your formula is net credit sales divided by average accounts receivable. So your average accounts receivable formula is, it is average, so divided by 2. So here we have debtors and bills payable, so opening and closing debtors and bills payable divided by 2. Net credit sales, so in this we consider only the credit sales. Why? Because it is debtors turnover ratio. So net credit sales formula is total sales minus cash sales and minus any sales return. Your third formula is creditors turnover ratio. Creditors turnover ratio, accounts payable arises on account of credit purchases. So what creditors turnover ratio directly related to net credit purchases. So formula to calculate is net credit purchases divided by accounts net credit purchases divided by average accounts payable. So net credit purchase is equal to total purchases minus any cash purchases minus purchase returns. So your average account payable formula is opening creditors bills payable plus closing creditors plus closing bills payable divided by 2. So your first question is, from the following calculate stock turnover ratio. They have given total sales return in words, that is nothing but your sales returns, stock at the beginning of the year, stock at the end of the year, and gross profits they have given. So your stock turnover ratio formula is cost of goods sold divided by average stock. So cost of goods sold, you have your stock sales given. So your total sales, you take it minus the gross profit which is given in the question, minus any return inward, that is your sales return. So you get your total up to be 2,40,000. Okay. So this is another formula for calculating cost of goods sold, which is sales minus gross profit. So average stock is opening stock plus closing stock divided by 2. So 40,000 plus 26,000 divided by 2. Now you get back to your formula, which is stock turnover ratio, cost of goods sold divided by average stock, which is 2,64,000 divided by 33,000 which is 8 times. So whenever you have your turnover ratio, you put it up in the times. So you express it in times. So next question is, the following particulars are available from the accounts. They have given direct expenses, opening stock, purchases, interest paid and closing stock. You are supposed to calculate stock turnover ratio and average holding period. So your stock turnover ratio formula is what? Cost of goods sold divided by average stock. In the question, they have given opening, closing, purchases, so you will use this formula. So the formula changes. So opening stock plus purchases plus direct expenses minus closing stock. So 12,000 plus 1 lakh plus 8,000 minus 12,000, which is equal to 1 lakh 8,000. So average inventory is how much? Opening stock plus closing stock divided by 2. So 12,000 plus 12,000 divided by 2, which is 12,000. So your total is 1,08,000 divided by 12,000, which is equal to 9:1 times. The next formula they have told us to calculate is average holding period. So average holding period is nothing but, formula is 365 days divided by the stock turnover ratio. So 365 days divided by 9 is your stock turnover ratio. So divided by 9, which is equal to 41 days. So moving on to our next question, which is, so average stock of a firm is 40,000. Its opening stock they have given 5,000 less than the closing stock. Find the opening and closing stock. So what is the formula that you will use? Average stock is equal to opening stock plus closing stock divided by 2. So 40,000 they have given. So opening and closing stock we do not know. So divided by 2. So opening and closing stock is equal to 40,000 into 2, cross multiply, which is equal to 80,000. They have told difference is 5,000. So minus your difference, which is 5,000. You get 75,000 as your answer. So opening stock is what? 75,000 divided by 2, 37,500. Closing stock is what? 75,000 divided by 2, which is 42,500. How do you get this 42,500 is, they are telling closing stock and opening stock difference is 5,000 they are telling, right? So 75,000 divided by 2 is 37,500. So if you consider opening stock to be 37,500, then the closing stock is 37,500 plus 5,000, which is the difference. So you get 42,500 as your answer. So your next question, cash sales they have given, credit sales they have given, total debtors they have given, beginning and end, return inwards they have given. So by this you get to know you're supposed to calculate your debtors turnover ratio and average collection period. So debtors turnover ratio is net credit sales divided by average accounts receivable. Net credit sales is how much? Total sales minus your return inwards. So total sales is 2,70,000 minus 20,000, which is 2,50,000. Your average accounts receivable is opening debtors plus closing debtors divided by 2. So 55,000 plus 45,000 divided by 2, which is 50,000. Debtors turnover ratio, which is equal to 2,50,000 divided by 50,000, which we have found out. So it is 5 times. Next they have told us to calculate average collection period. So average collection period is nothing but 365 days divided by debtors turnover ratio, which is 5 times, which is equal to 73 days. So your next question, so from the following information, calculate. Here they have told us to calculate 4 different ratios. They have given sales, creditors, bills payable, bills receivable, purchases and debtors. So debtors turnover ratio, the formula is net credit sales divided by average amount receivable. Here if you see, they have not given the opening stock, closing stock, nothing. So you will directly take the total of debtors and bills receivable in order to calculate the average amount receivable. So debtors plus bills receivable is equal to 59,000 plus 48,000, which is 1,07,000. So debtors turnover ratio is sales divided by average amount receivable. 8,75,000 divided by 1,07,000, which is 8.18 times. Second, average collection period. So average collection period is 365 days divided by debtors turnover ratio, which is equal to 365 days divided by 8.18, which is 45 days. Then payable turnover ratio is nothing but your creditors turnover ratio, which is equal to formalize net credit purchases divided by average accounts payable. So accounts payable, here you do not have opening and closing creditors. They have given creditors and bills payable. You will total up both. So creditors plus bills payable, which is equal to 90 plus 52, which is equal to 1,42,000. So payable turnover ratio is 4,20,000 divided by 1,42,000, which is 2.96 times. So average payment period is 365 days divided by creditors turnover ratio, which is 2.96, 123 days. See, note they have given in this problem opening balances of debtors, bills payable, creditors and bills receivable are not given. So you will basically have your hence closing balances are only considered for your collection of ratios. So closing balances only you will take it for calculation of your collection average period. So next set of ratios that we have is the profitability ratio. So profitability ratio, very important in an organization, is to measure the profits of the organization, how efficient an organization is working towards the profit. So there are various ratios which are help to analyze the earning capacity of a business. So we have, first one is your gross profit ratio. So this ratio basically expresses the relationship between gross profit and sales, and every ratio in profitability ratio will be expressed in the form of percentage. So your gross profit ratio is gross profit divided by your net sales into 100. Okay, so how do you calculate your gross profit? Gross profit is equal to net sales minus cost of goods sold, or if they give net sales cost of goods sold, then you use that formula, which is net sales minus cost of goods sold. Or if they give opening stock, closing stock, then you use the next formula, which is opening stock plus net purchases plus direct expenses minus your closing stock. Then you have your net sales, so sales, total sales minus any sales returns. So next ratio is operating ratio. In this ratio we understand the relationship between the cost involved in the sales and the operating expenses with the net sales on the other hand. So operating ratio formula is cost of goods sold plus operating expenses divided by net sales into 100. So cost of goods sold, what we have, net sales minus gross profit. Operating expenses, what do we have, office expense, every operating expenses which are operating in nature, which are basically involved in the production to sale of goods and services, such as office and administrative expenses, selling and distribution expenses, discount, bad debts, provision for doubtful debts, interest on short-term loans, depreciation, etc. So next is your operating profit ratio. Operating profit is calculated in order to find the relationship between the operating profit and net sales. So formula is operating profit divided by net sales into 100. So how do you calculate your operating profit? Gross profit minus your operating expenses. So your net sales is gross sales, that is your total sales minus your sales return. So your net profit ratio also is expressed in order to find out the relationship, the ratio relationship between the net profit and net sales into 100. So net profit, how do you calculate? Gross profit plus operating and non-operating income minus your operating profit, operating and non-operating expenses. So net sales is total sales minus sales return. Net profit can be taken as before or after tax, whichever is given in your question. So your last ratio is return on investment. This is an important test of profitability of measures. It helps in analyzing the overall efficiency of the business. So your formula to calculate is return on investment is equal to profit before interest, tax and dividend divided by capital employed into 100. So factors that we consider is from asset side, fixed assets plus current assets minus current liabilities, and from liability side we consider equity share capital, preference share capital, net reserves and surplus after adjusting your fictitious asset which is given in your credit side, then your debentures, loans, long-term loans minus your non-operating assets like your investment made outside the business. So probably when we do the sum you all will understand the formulas. So let us look into our first sum, which is calculate the gross profit ratio based on the following information. They have given cash sales. Cash sales is 25% of total sales. Purchases is they have given. Credit sales they have given. Excess of closing stock over opening stock they have given. So let us start with the resolution part. Okay. So you first have what you have is, first let us start with gross profit ratio, because we need to find out the sales. They have given credit sales, they have given the percentage of cash sales, but they do not given the total sales. So let us start with gross profit ratio, gross profit divided by sales into 100. So first let us find out total sales. So let total sales be 100. In that minus cash sales, which is 25% they have told. So what is your credit sales? 75. So when total sales is 100, 75 is your credit sales. So when total sales is question mark, we do not know total sales right now. They have given in the question credit sales is 2,40,000. So cross multiply. Total sales is equal to 2,40,000 into 100 divided by 75, which is equal to 3,20,000. So now you have your total sales. Now we are supposed to calculate our gross profit. What are we supposed to calculate? Gross profit. Because in the question they have told us to calculate gross profit ratio. We do not know the gross profit. Sales they have given 3,20,000, which we found out. Now what have they given in the question is excess of closing stock over opening stock is 20,000 they have told. So excess of closing stock over opening stock is 20,000. So add that 20,000. So opening stock minus closing stock is 20,000. So you get the total of 3,40,000 minus your purchases that they have given. So opening stock plus closing stock minus your purchases. So that is your formula. So minus purchases 2,76,000. So gross profit is how much? 64,000. So 64,000 divided by 3,20,000 into 100, you get your gross profit ratio to be 20%. So your next question, we have the trading and profit and loss account. So let us look into a profit and trading and profit and loss account. And what have they told us to calculate? They have told us to calculate expenses ratio, gross profit ratio, operating profit ratio, net profit ratio. So income statement, let us prepare an income statement. This is just for a convenience, so that we have all the figures out there, and so that we can immediately take the factors and calculate the ratio. So first we start with sales. Sales is how much? 5 lakh minus your cost of goods sold. So cost of goods sold, how will we calculate? Opening stock plus purchases plus any direct expenses minus your closing stock. So we have the purchases, factory expenses minus your closing stock, we get 3 lakh as your amount. So sales is 5 lakhs minus your 3 lakh, you get 2 lakh. So you have your gross profit. Now with this we can implement our gross profit ratio. So now minus your operating expenses, so administrative expenses, selling and distribution expenses, etc., which are operating in nature, okay, which help in the production and sale of goods and services. So which is 1,13,000. So if you minus it, you get 87,000 as your answer. So add if you have any non-profit or non-operating income. We do have, which is 6,000, and minus if any non-operating expenses we have 9,000. So total we get is profit before tax we get is 84,000. So now let us look into each ratio. So first ratio that we have is expenses ratio. The formula is cost of goods sold plus total operating expenses divided by sales into 100. So 3 lakhs plus 1,13,000 divided by 5 lakhs into 100, which is 82.60. So now if you see, we have something called as expenses ratio. Whatever expenses that we have in the question, the operating, direct expenses, everything we will calculate separately. So in question we have factory expenses ratio. So factory expenses ratio we will use is equal to, formula is factory expenses divided by sales into 100. So the formula for expenses ratio is expenses divided by sales into 100. So 7,000 divided by 5 lakh into 100, 1.40. Now we have next expense in the question given is administrative expenses. So administrative expenses divided by sales into 100, we have 20.20%. 1 lakh 1,000 divided by 5 lakh into 100, we have get 20.20%. Selling and distribution expense formula, selling and distribution expense divided by sales into 100, just 12,000 divided by 5 lakh into 100, which is equal to 2.40%. So non-operating expenses ratio is equal to 9,000 divided by 5 lakh into 100, 1.80. Now moving on to the next ratio, which is gross profit ratio. They have told us to calculate. Gross profit ratio is gross profit divided by sales into 100, which is 2 lakh divided by 5 lakh into 100, which is 40%. Operating profit ratio, in the question we have, in the answer we, in the income statement we have found out our operating profit, which is 87,000 divided by sales is 5 lakh into 100, which is 17.40. Our net operating profit is net profit divided by sales into 100. Net profit we have found out, which is our profit before tax, 84,000 divided by 5 lakhs into 100, which is 16.80%. Thank you everyone.